Good morning, everyone. Just want to do a quick little update today on ASANA. We've had a nice little pullback in the past 3 months, dropped about 30% with a market cap of $3.3 billion, going for around $14.89. Basically, they are an American software company. Their main service is a web and mobile work management platform designed to help teams organize, track, and manage their work. There's a new article on Seeking Alpha that I wanted to address, and so we could also give an update on this stock. Rating downgrade. And this video is just going to be a little bit about why I don't agree with this analyst. So to summarize this article, pretty much the bottom line, their growth rates have been slowing down the past couple of quarters and how they are still incurring losses for at least the next year. This is the latest earnings call from Q4 of 2024. It says they made a commitment that we would become free cash flow positive by the end of the coming year. Okay, so let's go ahead and start with the growth rate. So I just went ahead and pretty much went to financials, income statement. So I just exported out all the quarterly and total revenues and also earnings per share. And we'll take a look at the growth rates. So I cannot disagree with this article by Michael that Asana's revenue growth rates have been underwhelming, indicating challenges in maintaining their expansion. So as you could see, this is the latest quarterly data that they reported. And comparing that from the previous year, they made $171 million in revenue compared to $150 in January of 2023. That is only a 13% increase year over year. So pretty much the 2022 year, you could see that they were growing at around 45% to 40%. So they were having an average growth rate of 40 to 50%. 2022 to 2023, their growth rates did drop a lot. I have plotted the number of customers that they are acquiring. I got these straight from the earnings presentations. Number of customers spending greater than $5,000. They're at 20,782, and comparing that to last year, that is only a 15% increase year over year. In 2023, they had around 18,000. That is only a 15% year over year. And once again, as you could see, there is a slowdown in the growth of their acquisition of customers. So yes, I cannot deny the fact that Asana's revenue growth rates have been underwhelming and they are slowing down. So from the latest Q4 earnings call transcript, 2 things they are going to focus on in the 2024 year is their commitment to become free cash flow positive by the end of this year. We'll go into that subject next. Another thing they are focusing on is re-accelerating their revenue growth rate. But besides having a slowdown in growth, they are still gaining revenue year over year. Their earnings per share have been improving year over year, even though there is a slowdown. And also, when they take a look at the number of customers they are acquiring, it is still growing year over year. It's just at a slower growth rate. So I don't know if we want to take that into consideration, that the company is still growing. So this article talks about how Asana is expected to continue incurring losses for at least 1 year, if not 2 years ahead. This is where we're going to use a little bit of imagination. Since Asana is a tech company, most tech companies are deploying billions into sales and marketing and research and development to grow their future earnings. Now, this spending is anchored in sound business logic, but it has an effect in depressing their current earnings report. We'll talk about the reasons why their earnings are being depressed and if they are depressing them on purpose. Since we are in the digital age, it's kind of obvious that tech companies' current income statements are really an unreliable way to measure their long-term ability to generate cash flows. Alright, so this next part, we're going to focus on the operating expenses. Why investors can't see returns today due to outdated accounting conventions. For those who don't know what GAAP is, so generally accepted accounting principles. So according to GAAP, they require nearly 100% of research and development and marketing to be immediately expensed. Alright, so we're going to go to Asana's latest 10K, and we're just going to go straight to their operating expenses to sort of talk about each section. As you can see, under operating expenses, they have research and development, sales and marketing, SG&A, and according to GAAP, they require nearly 100% of research and development and marketing to be immediately expensed, causing them to show a net loss in the bottom line, while it allows hard assets like property, plant, and equipment to be depreciated over many years. Okay, so here's just a little sheet that I just want to demonstrate this real quick so we can sort of see the differences between 2 different companies. So say you have an industrial business and they decide to invest $100 million in a plant. Now, that plant has an estimated 25-year lifespan, so they're only going to recognize $4 million a year in expenses for that plant. So let's go ahead and write revenue. By contrast, a tech company that spends $100 million, they don't need to use a lot of money on equipment, plants, rental space, and all that. What a tech company does need to spend on is consumer-focused research and development and also sales and marketing to sort of market their brand. But say they spend $100 million, they're going to have to recognize that whole $100 million that year. compared to an industrial company who only has to show 4 million that year. So if both companies had revenues of 100 million and no other expenses, the industrial company's profits would be 96 million. And for the tech companies, their profits would be 0. So pretty much today's accounting rules make old economy income statements unreasonably attractive and new economy ones look unreasonably unattractive. So this page right here, this is just the 10K, and I'm focusing on operating expenses. If we go ahead and input this data, and mine's gonna be backwards, my latest years are gonna be to the right. So 2022, I'm gonna have 604, 898, and 857. All right. Next, I'm going to individually input sales and marketing and research and development. So once I have that data inputted, my next line right here, so my next line is advertising percentage. Out of all the money they spend on operating expenses, how much is it is going to advertising alone? ASANA is spending around, I guess you could say around 50% of their total operating expenses just on sales and marketing alone. Now, what I'm going to show next is how it's affecting earnings per share, which is pretty much the bottom line that investors are looking for. They want to see positive earnings per share. I'm going to have sales and marketing and research and development per share. I added up the sales and marketing and research and development costs, and I just divided it by total shares outstanding, and it's going to give me sales and marketing / research and development per share. Now, from what I said earlier, the reported earnings of growing tech companies are pretty much understated due to the expensing of large investments in strategic assets, and one of those strategic assets for tech companies is sales and marketing, customer acquisition costs, brand creation. Pretty much all this is labeled under operating expenses. So for ASANA, one of the main strategic resources they have is their customers. So they need to be able to acquire customers. That is why they're spending a lot on sales and marketing. So let's just say ASANA decides to stop investing so much in sales and marketing and research and development. What would happen in an ideal world where a tech company is treated the same as an industrial company? Sales and marketing and research and development are investments for ASANA. So it's pretty much the same as an industrial company who is investing in plants, real estate, and all the hard assets that they're able to depreciate over the long term. So earnings per share without marketing expenses, pretty much what I did here. I went ahead into the income statement and pretty much I just took the earnings per share that ASANA is reporting, and I'm taking out the sales and marketing and research and development per share price that I got. So for the 2021 quarter, they posted negative $1.63. I pretty much have it right here, and I'm just taking that formula and I'm adding it and summing them up. Say ASANA decides to just slow down on the sales and marketing and research and development. They pretty much already have positive earnings per share. These old accounting standards that we're still using are affecting these tech companies. They're pretty much already earning positive earnings. So if we could spend marketing dollars today to add profitable customers for years, then does it really matter if it depresses current earnings? So yes, ASANA is expected to continue incurring losses for at least 1 year, if not 2 years ahead. But are those losses only happening because of our old accounting standards? So just to sum things up, yes, it does look like ASANA will still be posting negative earnings for this year, but they are working hard to increase their subscriber growth and to also hit positive cash flows. So even though they are posting negative earnings and their investments in sales and marketing and also technology and development are sort of affecting the bottom line, they are still on a pathway to positive earnings and positive cash flows. Wouldn't now be a good time to be investing in ASANA? Let me know what you guys think. Thanks for watching.